All right, so let's take a look at specific emotions that's going to affect you as a trader. The first one is greed, and greed is a big one because most of us go into the markets because we want to make money, right? So we have a certain level of greed, but you can't let the greed overcome you, all right? It's kind of like what Jim Cramer says on TV, CNBC says, bulls make money, bears make money, but pigs get slaughtered, right? So if you're a pig and you're greedy, eventually you're gonna end up blowing your account. So greed may cause you to raise profit targets too high and to stay in the trade too long. This can cause future winning trades to become losing trades. So here's a typical example. So say you went long over here and you had a profit target of 1.5R. As you've learned in most of my lessons, that is my usual profit target for Forex 15-minute candles. And the moment you enter, whatever the price spikes up, hits your profit target, you get 1.5R, which could be whatever, right? $500 or 1 grand or 5 grand or whatever money you made, and you feel, well, great, made the money, right? But guess what? The moment it hit your profit target, the price continued going up, going up, going up, going up. Say, shit, if I stayed in the trade, I would have made, instead of 500, I made 5 grand or 2 grand or 4 grand. So why did I take profit at 1.5R? What's the deal, right? And guess what happens, right? And you start to have this thing called regret. All right, you buy there, right, here's your profit target, goes up, and you have regret. I should not have sold too early, should have stayed in the trade. So the next time, you know what, I'm not gonna have a profit target, no profit target, or I'm gonna put my profit target at 2R or 4R. And oftentimes I get emails and people ask me, Adam, why do you put your profit target at 1.5R? Why not 2R? Why not 3R? Why don't you put a trailing stop loss? Hey, you think I'm stupid? You think I don't want to make more money? All right, I've been trading for 26 years. Don't you think I would have thought about it? Duh. Okay. Sure, when you see the price running, you think I could have been there. But I can tell you it doesn't happen all the time, right? When you enter a trade, you don't capture a great trend all the time. In fact, that is the exception rather than the norm. Most of the time, after you enter hits your profit target, you go sideways or goes down or whatever can happen. So you cannot take one event and generalize it. And the danger by doing that is that if you put your profit target too high, like for example, in this case, you say, okay, I'm going to put my profit target at 4R. No 1.5 for me, I'm going to put 4, 3R, put a trailing stop. That's what's going to happen. Sure enough, the next trade is going to go up. It's going to hit maybe 1.5R, right? And then, right, goes down, turns out to be a losing trade. Or break even, for example. And instead of getting your 1.5R, you got 0, you got -1. And trust me, that happens. All right, so stick to your profit targets. Now, I'm not saying that you have to put 1.5R. It depends on your strategy, right? So in other strategies I use, I may put a 2R target. Or for example, when I trade stocks, in certain cases, I may even have a 4R target. It depends on the strategy. So what I'm saying is in this particular strategy, which I use in Forex, which is the impulse pullback, impulse pin bar with 50-minute candles, I found 1.5R is the optimum for this strategy, okay? But I'm not saying that it must always be 1.5R. Okay, just bear that in mind, right? So again, you can see in this case, the win becomes a loss because too high a profit target, or you didn't get out. Okay, good. Next one is fear, all right? So fear, let me give you an example of fear and frustration, okay? So let's imagine you place your buy order here, okay? Your stop loss is there, so that's 1R of risk. And your profit target is 1.5R, okay? Great. So say you take this trade, right? You enter here, it goes up, right? And it almost reaches 1.5. Doesn't reach 1.5. Say it reaches 1.3R and goes down. And you end up with -1R loss. How do you think most people will feel? They feel a bit upset, right? Like, damn, I had 1.3R in my pocket and it was gone. Never mind, let's go for the next one, okay? Control my emotions. So next time, you go in again and you buy and it goes up and say now it goes to say 1.2R or 1.1, whatever it is, and then it goes sideways and goes down again. And damn, lost another trade, 1R loss. Now you get a bit frustrated. I had 1.3 in the pocket, it was gone. 1.2 in the pocket, it was gone. I was so close to my profit target. Let's go for the next trade, right? So the next trade, you go in and you buy, and it goes up, and say again, it hits 1.2 or 1.3, goes sideways, and you go now lost again, right? And I can tell you that for most people, after it happens 3 times, they're gonna say, you know what? They start to get upset, right? Because they say, if I had taken my profit at 1.2 or 1.1 or 1.3, I could have had 3 small wins instead of 3 losses, right? So guess what? Now they get affected emotionally, and they got this fear that what they have is going to be taken away. So the next trade they go in, which is this trade, stop loss at 1R, okay, profit target at 1.5R, all right, and they enter the trade and it goes up, okay, and say it goes up to here. Right? No, let me do that again. Sorry. Okay, so they enter the trade here, right? It goes up to, let's say, instead of 1, it has not hit the profit target yet, but say it's up to 1R here. Example, it's a 1R, okay? And it goes up to 1R, and it starts to come down. They see this red candle, and they say, oh, I've seen this movie before. I remember this, right? I had some money, but I lost it. So shit, I better get out, right? So they quickly They quickly sell, right? They quickly get out even before their stop loss is hit, profit target or hit. They intervene, they get out because they're watching the market, right? And I keep saying this: once you're in the trade, don't watch it, right? Go fishing, do something till it hits your profit target or stop loss. Because when you watch the market, it goes up and down, you get very emotional. You're bound to intervene. All right, sure enough, you intervene and you sell, and you get your 0.7R. All right, at least got some money, right? And then after you sell, it goes down. Luckily, I sold it, right? But you know what? It doesn't hit your stop loss. And then, boom, it goes up and it hits your profit target. And you look back and say, damn, if I had stayed in trade, I would have gotten 1.5. Now I only got 0.7. Shit. So what happened? Because of your past conditioning of your past 3 trades, now you took profits too early, and instead of getting 1.5, you got 0.7 R. Now, if you keep repeating this pattern, guess what? You keep getting trades with smaller wins instead of the usual 1.5. You get 0.7, 0.5, right? And what happens? The moment you do this, your trading system no longer has a positive statistical expectancy, because in the long run, your wins can't cover your losses, because your loss is always going to be 1R, or your win is going to be less than 1R, or not enough to make it worth your while. All right. So what happens is you could get this outcome. Okay. So again, by taking small profits and not allowing winning trades to achieve their fullest profit potential, your system will no longer have a positive expectancy. Your profits on the wins may not make up to cover your loss on the losing trades. So you may end up with this outcome where you get 1, 2, 3, 4, 5. You get 5 winning trades, you get 3 losing trades. You should be a winning trader. You should be making money, but you're not, because, right, if you add up -3 and you add up the wins, this can't cover the loss. So even with more wins than losses, you still end up with a negative expectancy. Okay? So this is a very, very common mistake that people make. Now, the next one is hope. All right? I like to say that in life, it's good to have hope, right? Hope your children will listen to you. Hope you have a good health, But in a market, never have hope, because in a market, hope is for the hopeless. Hope kills you. Hope destroys you in the market. Have no hope in the market, right? Only in life. Okay, let me tell you why. So let's imagine the first scenario. You bought there. Your stop loss is here. That's 1R risk per trade, right? And the moment you buy, what happens, right? It goes down, it hits your stop loss, and right there and then the price zooms up. Okay? Now, how do you think most people will feel at the point of time? Damn! It was a winning trade. My stop loss was too close. Okay? Or, I'm just unlucky, hit my stop loss and the market's teasing me, the market's screwing me, someone up there hates me. They get all emotional, right? So what do you think they're going to do the next time? Next time, I'm not going to put a stop loss. Real men don't put stop loss. Someone once told me that, and now he's bankrupt. Okay, or they say, next time he's gonna hit the stop loss, I'm gonna move my stop loss and give myself more time, right? And sure enough, what happens the next time? The next time you buy, you place a stop loss there, like a good boy. Oops. And sure enough, what happens? You've got your predefined risk of 1 hour, your predefined risk. But the moment you buy one, it goes down, you're watching the market, which I said, never watch the market when it's open, right? You watch the market, it's going to hit the stop loss. Oh my God, I remember watching that movie before. It hit the stop loss and it went up. You know what? So I got to move my stop loss. So you shift your stop loss down to give yourself a bit more room. And sure enough, what happens? It goes up, yes! Oh my God, it goes back down again. It's going to hit my new stop loss again. What do? Shift my stop loss lower, give myself a bit more room. I know it's going to recover, it's going to go up, it's going to go up. But it doesn't go up until eventually, oh my God, I'm losing too much. Boom! And instead of losing 1 hour, you lose 4 hours and 5 hours. Right? And that's why there are some people with, I know some people who win 9 out of 10 times, but the one time they lose, they wipe everything out because they didn't predefine their loss. So in trading, we always say that manage your losses and the wins will take care of themselves. Okay? So big loss, that's right. So remember that the overall outcome of a trading journey will not unfold linearly, right? Your capital will not go up in a straight line. It just doesn't happen. Your money just doesn't go up like that. Nothing goes up in a straight line in real life, okay? So do not look at the trading outcomes in a certain period and extrapolate results forward into the future. So this is a typical equity curve that you can expect as you trade. From say 10 grand, as you trade, it may go up to 50 grand, right, over say 100 trades, whatever it is, depending on your risk, right? So notice that there'll be periods of time like here where you have what I call a drawdown. A drawdown is a fall in your capital as a result of losing trades, which are inevitable. So you have got losing trades in a row. In this case, you had 5 losing trades in a row. 5 losing trades in a row, right? 5 losing trades in a row. It's going to happen, right? And the trouble with many people is that once they have got this 5 losing trades in a row or 6 or 7 losing trades in a row, they start to say, if I continue like that, I'm going to lose everything. So they start to extrapolate forward and they generalize. At the same time, if you get a string of winning trades over here and say, oh, I got 5 wins in a row, if I continue doing this, I'm going to be a millionaire tomorrow. Right? And they extrapolate, not knowing that the market is not linear, doesn't go up in a straight line. The market goes up and down. That's how the market is. So we should neither be discouraged by losing streaks or carried away by winning streaks. In the long run, losing and winning streaks will even out each other. It is the long run distribution of wins and losses that will make us profitable. And the long run performance, our long run performance has got nothing to do with luck. Nothing. In the short run, I can say it's all luck. Right? You place 5 trades, you win, it's luck. But in 100 trades, 200 trades, it's not luck. It's skill, it's psychology. Okay? Let's review some of the common emotional mistakes in trading. So you may want to print it out, paste it on your wall, and notice if you are doing that. If you're doing that, you got to stop it. All right? So common emotional mistakes. What do losing traders do? Losing traders rush into new trades after experiencing a few losers in order to quickly win the money back quickly. That's a very common mistake, right? When a trader makes a few losses, they say, I gotta take the next trade quickly to make back the loss. And they start to take low quality trades that do not meet the rules. But they say, I gotta take it to just make it back to break even for the day. No, that's a mistake, all right? Or the opposite, right? After having a few losing trades, they then have the fear of taking the next trade, right? They look at the next trade, the signal is there, but they don't take it. They say, because what if this one's a loss again, and boom, turns out to be a win, and they were not there. Or losing traders stay in a losing trade, hoping things will turn around, right? And not having a stop loss. Losing traders focus on short-term results and lose their perspective. Losing traders fail to stick to a consistent percentage risk per trade. Winning traders always risk the same percentage, 1%, 1%, 1%, or 3%, 3%, 3%. Losing traders right? When they start to have a few wins in a row, they say, hey, I'm good, I'm on a winning streak. They raise their risk per trade from 1% to 10%. And the moment the winning streak ends and the losers come, the losers wipe out all their winners. One loss of a 10% risk wipes out a few wins that they made early on with a lower risk. And some traders, when they start to lose, right, they say they risk 2%, they lose, and they start to say, okay, the next one I'm going to risk only 1%. And when the wins come, it can't overcome the losses because they keep changing their risk per trade. Okay, losing traders constantly change their trading systems and strategies after experiencing short-term losses. Right, so the moment they get a losing streak, they say, let me add a MACD there. Let's add a stochastics. Right, let's change the strategy altogether. Let's go trade Forex, stocks, options, and they go around in circles forever. Losing traders focus on the account balance instead of following the system. They keep looking at their equity going up and down, they get very emotional, instead of following the process of the system of placing good trades and letting the equity grow by itself. Losing traders get emotionally affected by losses. Again, fear, frustration, stress, loss in confidence. Losing traders always blame and find external reasons for their losses. I lost this month because the market was bad, because the Federal Reserve increased interest rates, because of my bad luck, because of my bad feng shui or my 八字 or whatever crap. Okay, losing traders have the need to take revenge on the market after experiencing a loss. They lose money, I'm going to take revenge on the market and make my money back. Okay? Quite a revenge trading always ends up worse, right? Losing traders will trade with methods that do not suit their personality. And too often people will hear of another success out of envy or lack of self-confidence, and they feel compelled to copy someone else's trades. And you'll end up with a loss. Because you must always trade with a system that matches your personality, that you have tested, that you have learned. Okay, so what are the habits of successful traders? The complete opposite, right? So winning traders are winning traders because they always take action when there's a valid and high probability signal, without questioning, without hesitation, without reservation. And these are the words of Mark Douglas. The late Mark Douglas was one of the best psychology coaches in the world, right? He always said, you have to trade without reservation, without hesitation, without fear, and that's when you trade in the zone, right? So winning traders don't let their fear control their decisions, and they don't let it interfere with their trading. Successful traders take responsibility and learn from their mistakes and move on. They don't dwell on setbacks. Successful traders expect and accept losses as part of the game. Right? Losing is necessary to win. So they don't get upset when they've got a losing trade. Part of the game. Successful traders focus on following the trading system, and again, not the immediate money they're making. Successful traders think statistically and keep a long-term perspective. Successful traders focus on being consistent in applying the rules. All right? Both exit and entry rules. Okay? Successful traders are patient. They only wait for high probability opportunities. All right? And remember, at the end of the day, the biggest enemy to your trading success is not the market. The market's not against you. The market doesn't know who you are. Right? Don't get too egoistic. The biggest enemy to your trading success is you. Right? So again, let me reiterate. A good trade is one where you follow the rules of the system and not one that led to a profit. Alright, so you like the videos, do subscribe to my channel for more videos. At the same time, you can visit piranhaprofits.com to check out online professional trading courses. My stock trading course is available. The Forex trading course will be available in November of this year. If you want our live courses we have in Asia, do check out wealthacademyglobal.com. This is Adam Khoo signing off.